All right, let's talk about trading in 2026. Actually, in the end of 2025, got about 2 months left here, and it has been volatile and news-driven. So news-driven markets make it very difficult for people to navigate what's going on. We've been around this long enough that I can tell you, we've seen just about everything, and, this is going to be just one of those years where we're probably going to have a couple years like this of, just lots of things that are unexpected, unpredictable coming along and swinging the markets one way or the other. And the good news is there's a way to navigate it and there's a way to make the most of it. And you just have to be sure to know what part of the day you want to focus on and exactly what it is that you're trying to accomplish. For those of you who don't know us, I am Adrian Manz. That's my lovely wife, Julie Manz. We are market researchers, market traders, analysts. We've been doing this for a long time, so it's been about 30 years now. That's us down on the floor of the New York Stock Exchange. We spent a lot of time down there doing data gathering, trying to figure out over the years where markets get their personality from, what the people who drive markets do in terms of influencing the market's personality. And I think it's made for a unique insight into how markets work. We're both psychologists. We have our PhDs in psychology and organizational psychology, specifically behavioral finance. So, we just have our hackles into what about a market is less sort of machine driven and more driven by humans, emotions, by psychology, by reactions to what people are seeing. And I think that's been a very unique edge for us over the years and for the traders we work with. We work with a lot of traders and, well, not a lot. I mean, we work with a group of traders every year. We do a boot camp with our guys and we work with about 20 people twice a year, get to know them pretty well and work with them pretty much one-on-one over the course of a year or 2 years and just try to get them up to speed, working with markets, profiting from markets, and trading the markets professionally. First and foremost, psychology is job one when it comes to trading. So this is our show. This is Trader Nation. And before the Palisades fires, we were doing this up in Los Angeles. We lived up in Pacific Palisades. Now we're down in Newport Beach. So we're going to do this as a web-based show instead of a studio-based show. But it was all about the psychology of trading. And it's really focused on how traders are made. Traders aren't born. You get good at trading, just like you get good at many things. And the way you get good is you have to take your licks and you have to take an emotional beating and you have to really become the master of what's going on in your head and the master of sort of how to control your emotions and knowing how to ask questions and getting yourself out there and getting help when you need it. The show is really about that. So it's not a stock analytical show. It's a show about if you'd like to send us something and be featured on the show, you can take just an iPhone video and send it to us, something along the lines of, hey, I get into trades and when I'm in, I tend to, take profits too early, let losses run, turn morning winners into afternoon losers. All these things are fair game. So if you have that kind of a thing, you can send a video off to us. I am Adrian at TradeOutLoud.com. It's my email address. Happy to take your video, and if we use it, you get one of those beautiful coffee mugs there. They keep calm and trade on coffee mugs. So today, I want to talk to you about trading strategies and what it is that you do when markets are really volatile and what you can do to get some edge in the markets when it comes time to run your trading business. Whether you're brand new to this or you've been trading as long as we have, I think it's just great to go back and review the groundwork and try to put yourself in front of these are the things that I need to understand to figure out how I'm going to profit in what's coming up down the road, 2026, 27, 28, probably into the future. I think AI is going to have a pretty earth-shattering effect on the world of trading. I think the more that you dive into this stuff now, the better equipped you're going to be to deal with that when it comes along, let alone what's going on right now. We need to understand what news-driven markets are all about. And in that, we need to understand different time of day effects and what time it is that we plan on trading and what the probabilities are for success during those times. We need to focus on having the best tools and being as prepared as we possibly can for intraday trading. So this means choking up and getting some good software and not being so focused on everything has to be free, everything has to be completely cost-free. Businesses don't run free, businesses don't run cost-free. If you think you're getting free commissions, I've got news for you. There's no such thing as a free commission. Everybody's paying. So if you're not paying a direct commission to place your trades, I guarantee you're probably paying more than I am per trade because you're getting slipped and I'm not getting slipped. So that's a function of having the best software, having the best execution platform, and having the best routing that's possibly available. I want to talk about a couple of core day trading strategies for high volatility. What you can do intraday to put yourself in front of opportunity, particularly around the opening bell. Talk a little bit about risk management and maintaining psychological discipline, and then how do you go through and evaluate your trade performance and make continuous improvement. It is not about evaluating everything that's happening as it's going on. It's about going back and giving yourself an objective framework to figure out what's going on with your trading and how it is that you can improve. In our trading, there are several factors that are going to influence what determines market volatility. Market volatility comes from just the rapid fluctuations in prices over short periods of time, and really it comes from three different things. For us, it's economic data, so you have to keep your finger on the pulse of what the economic data is that's coming out every day. Is it CPI? Is it PPI? Is there going to be, besides inflation data, jobs reports, housing numbers, all these things have big impact on the market, especially right around the opening bell. Then we want to know about geopolitical events. Those create lots and lots of uncertainty, and there's going to be big market changes. So geopolitical stuff can really affect particularly the banking industry. It can affect oil and gas. It can affect things that are subject to tariffs. It can, all these things that you see getting whipsawed by news. You have to think about what is the geopolitical impact of the news and how deep is that geopolitical impact. A lot of times, something might look like it's less in terms of the impact that it's going to have because, let's say, it's just some banking regulation or it's an interest rate announcement. Well, it can have really deep ripple effects, especially when it comes to the banking stocks. So I personally don't trade banking stocks. I also don't trade oils because they have a lot of very unpredictable volatility that comes along with the geopolitical announcements that we see more and more in the news every single day. Right now, we are in a geopolitical hotbed, and I don't see that ending anytime soon. There's lots and lots of agitation in politics. There's lots of agitation in international relations. And, we just need to understand what the causes are of everything and try to anticipate and react efficiently. Corporate earnings reports, this is something that we can use to really drive our trading performance. So for us, corporate earnings mean we're going to be looking for earnings gaps, and we are looking for gaps in stocks that are more than 2 standard deviations in terms of volatility of what we would expect in the price of the stock. And then we have a big gap fade that I've talked about in other seminars and lectures and things that I've done here for David and for the Money Show. And you've seen me do them just live probably all over the web over the years. The Baltimore Chop, the 2 standard deviation opening gap reversion trade that I do is something that most people know about. And that one is just all about let's anticipate the anticipators, as Bernard Baruch said. So it's all about getting in there, figuring out what is likely to happen as a result of earnings. Those reaction moves are almost always overdone. So when they happen, we can bank on the fact there's going to be a reversion to the mean in terms of volatility. But all of these things are things that influence our trading every single day. And, the corporate earnings reports, those are things we want to get in front of. The economic data, that's something that we want to get in front of. And the geopolitical events, a lot of times tends to be something that we want to avoid. News is going to be bigger in your trading now than it has been over the past 30 years. We've gone through periods of closely monitoring the news. We've gone through periods of not monitoring the news at all. Right now, a live news wire is probably more important than ever. And I don't mean watching CNBC. I don't mean watching Fox Business or having MSNBC or Fox News or any of these news outlets on. That's all stale news. That's there to sell you catheters and reverse mortgages. That stuff is out there for advertising dollars. What I'm talking about is live news wires. So whether it's Reuters or the Fly on the Wall, or, well, there's any number of them, right, that provide good information. The news events that are coming out, that are hitting the wire, that are fresh, that haven't been talked about all day, they can cause very, very sudden and very sharp price changes. And the dynamics of the things that you're trading are going to change very, very suddenly. And when you get whipsawed in and out of positions, it's really no fun. And it's a terrible feeling to get caught in something and realize later that the reason that you got caught is you didn't understand the impact of some news event that was going on. You probably didn't even know the news event was happening. It's a good idea, with that backdrop, to really think ahead of time about how different pieces of news might affect the market. I'm not saying you know what the news is going to be, but you can anticipate what the news is going to be. There's a lot of stuff out there right now about nuclear power. There's a lot of discussion about just, interactions with other nations in terms of tariffs. So you can think about, what's the impact going to be if there's a positive announcement about nuclear energy, if there's a positive announcement about rare earth mining, about just any number of things, or a negative announcement about those things. And where do I want to be if those announcements come during the trading day? What do I think that's the market's reaction is going to be? What's going to be the sentiment of the market if such and such an announcement is going to be made? And, where do I want to be in terms of position sizing, in terms of, do I want to be in a position? Do I want to widen my risk? Do I want to narrow my risk? Am I going to get whipsawed in and out of positions? These are all things you should think about before the news hits so that you're prepared when it does happen. Even if it doesn't happen at all, it's just good to think about these things ahead of time. If you are using Metastock, their Reuters platform is fantastic. Those two companies are intertwined, obviously. If you are looking for sole suppliers of news, there's Financial Juice is a good one. The Fly on the Wall is a good one. Trade the News, obviously a good one. Those are credible financial news outlets that are going to get you in front of the news before the talking heads on television are going through it. By the time it's on TV, it's too late. The economic news, the economic calendars, you can go to forexfactory.com. They have a really good economic calendar there, and you just pull that up. We've got an economic calendar that we prepare for on traderinsight.com. It just gets you ahead of the announcement so that you know that the announcement's coming. It's very important to get up in the morning and know what the drivers are. Oh my gosh, the market's up, 400 points, or the market's down 900 points, and what's going on here? Oh, well, wait a minute, the producer price index is coming out today. Let's see if that was a hot number. You can also monitor social media. I think that things like stock twits still provide useful information. Just a Twitter feed provides useful information. All of these intraday feeds provide useful information, less so than news sources that you can go to and vet. So just about anybody can say anything on social media, but I think that it's good to at least be aware of what's going on in social media. Just don't get yourself too involved in the conversation, or you're going to find you don't have time to react to the trade. You're going to wind up just getting yourself involved in the conversation and usually in an argument, and that's really not going to help you find the best trading opportunities. Preparation is going to be key when trading volatile markets. And I think that focusing on things like economic calendars, alert systems, and choosing the right trading platform, these are going to help you establish routines to keep you ready for news-driven opportunities. So economic calendars are going to provide you a schedule of upcoming financial data releases. So as I said, you can go to forexfactory.com. That's totally free. Trader Insight, we've got things up there. It's totally free. But these things give you a list of upcoming data releases and events that they're going to impact the markets. And couple those with news alert systems, ones that we just talked about, and these are the tools that are going to help you stay informed in real time and allow you to anticipate and respond to market volatility effectively. When it comes time to react, you're going to need good tools. Selecting an appropriate trading platform, a piece of software that's going to get you in front of fast executions, that's going to get you in and out of the market efficiently, is probably one of the most important decisions a trader can make, and most of you will just take whatever your broker's giving you for free. I think that's a big mistake. There are high-quality platforms out there that come with a brokerage relationship. TradeStation, Schwab's Active Trader. There's things out there. We've got guys who work on Thinkorswim and are very happy with it. For us, we use a dedicated EMS. So we've got an execution management system called Realtick that it's now the ES EMS, and we've been using it for the last 30 years. And it's the fastest, hands down, just the fastest route in and out of the market. Gets you in front of the opportunities as quickly as you can possibly get in front of the opportunities. It's not cheap. It's $370 per month per terminal. And Julie and I both have our own terminals, but what we know is we don't spend a lot of time every day crying about slippage and missed executions and not having executions that are fast enough. It's got very, very advanced charting. You guys who have watched us live or watched some of the trading competitions and things that we've done, or some of the live trading that we've done online, the live streaming stuff, we can manipulate that chart data in ways that gives us very, very clear insight into what's going on in the market without having to display 5,000 indicators all over the screen. Sometimes people are just hooked on, a platform has all these different charting indicators that I can plot. And boy, if I put all these things up there, I can't really see the price data anymore. I can't really see the chart underneath there. But if I just watch these squiggly lines, I can probably figure out what's going on. That's not going to help you. It's really a matter of, you want charting that makes sense out of what's going on in terms of price. You want charting that goes and manipulates what's happening with price and gives you a view into the data that's a little bit different, or gives you some edge over what the typical platform has given you, the typical just out-of-the-box platform. You want something that has resources and something that has news integrated. So in Realtick, there's integrated news. In TradeStation, I think you can get some integrated news. In Schwab, you can get integrated news. The quality of that news is going to get better and better as the platform that you're using is more and more advanced. So these are all things to think about. They're all things that give you edge in trading. And I think the further down the road of AI and the further down the road of machine learning and everything that we go, the more important it is that you've got a platform that's very, very advanced and very, very capable, it's also got to be something you can understand. So you don't want necessarily to have an institutional grade platform or be sitting in front of a Bloomberg terminal or something if it's not going to be a piece of software that you can really wrap your head around. You want to make sure that the thing you're working with is giving you fast execution, advanced charting, news integration, and enhances your decision making and enables you to react quickly during fast moving market conditions. You don't want to wind up being in a position of not understanding how your software works and then missing trades. Once you have the best trading software for you, once that's in front of you, once it's on your desktop, you need to be sure that you've got a routine in place that's going to help you take advantage of what that trading software is capable of. You need to have a routine in place for the pre-market, and I would say you need a routine in place for every part of the day. In the pre-market, we want to make sure that we've got all the upcoming news under our belt. We want to check the relevant financial news. We want to get in there before the market opens, know what's driving things, know what's going on, analyze the charts, look at the broader markets, prepare yourself for the trading day and be ready to make informed decisions by knowing the stocks that you're about to trade. So if you trade Tesla every day, if you trade the Dow Jones, if you trade the S&P 500, if you're an ES trader, an NQ trader, a Spider Diamond Q kind of a guy, or if you're just trading the Magnificent Seven, you want to go through, look at those charts, and make sure you know when was the last time the stock made a new high. How close am I to those new highs? Am I at a double top? Am I at a triple top? Am I coming up on something that institutional traders follow? Am I crossing the 50? Am I crossing the 200 period moving average? Simple things can make a difference in whether or not you're going to be able to react during the day. I set alerts. I want to make sure that I know where something is coming into an area that it fell off yesterday, for example. So if I'm looking at the short side of the market, and let's say I'm looking at the short side of the market in Tesla, and I want to figure out where's the highest probability short going to be for tomorrow, what I want to do is dig into the charts today, dig into the charts for the past week, past few weeks, and see when price hit a certain level, has it just consistently reversed away from that level? Are there call walls? Are there put walls? Are there big options trades out there that the market is going to steer price away from? If we've got millions of shares potentially that are going to go off as in the call market, we know that's a market maker who's hedging his bet against that move happening. They're going to do their best to prevent price from getting there. If we know ahead of time where those levels are, and we set alerts that let us know when price is getting close to one of those areas, what we can do is just take away the impulsive decision making. Impulsive decisions are bad. Your gut reaction rarely going to make you money. Most of the time, that story's got a beginning, a middle, and an end, and the stuff in the middle all going to be bad. You're going to hate every last minute of it. If you can reduce impulsive decision making, if you can take the emotion out of trading, what you can then do is improve your ability to focus during the session and then interpret what's going on in terms of the volatility and what it really means to the trade that you're about to get into. So I've got some core things that I work with during the day. I think I just want to look at a couple key strategies that have been effective in volatile markets. This includes momentum trading, breakouts, breakdown approaches, and some scalping techniques that I've designed for some fast-moving price action. I'm intentionally keeping the strategies here, the examples here to a minimum, because I really think this time around what I'd like is for everyone to just sort of focus on the process and focus on the thinking. How is it that I need to think about the markets in terms to get myself profitable? There's a lot of roads to profitability, and it's not necessarily true that just because I'm using something, it's something you should be using it as well. But these are ideas. These are aha moments for some people, and these are not for me moments for other people. But one way or another, I think it's just always useful to get into somebody else's head and see, oh, well, here's a couple things Adrian's doing these are interesting to look at, and oh, I get it. I see what he's looking at. Interesting. And as we go through these, the first of these are really momentum trading ideas. And, we're non-directional traders. Julie and I are really more order flow traders than anything else. But when you are trading momentum, you are definitely capitalizing on some directionality in the market. So you're looking at strong price moves. And a lot of times it's driven by news, so like earnings. The gap fade is definitely directional. We are looking for a counter trend move on the gap trade. We are looking at what's happening in terms of volume. So in our case specifically, we look at volume by price. We take volume by price, establish points of control a little bit differently than is traditional. We do a hierarchical cluster analysis of volume. I'll show you what that looks like in a second. The volume by price analysis goes and gives us a way to confirm whether or not momentum is going to get into a pocket in which it can really accelerate. And then do we have the ability to take a quick profit from a trending move? We do this over the course of the day. There's lots of times that we're looking for quick profits. This can happen right around the opening bell, as in the example that I'm going to show you here in Tesla. It can also happen in the 11:30 a.m. till about 1 p.m. or maybe 2 p.m. session of the market when normal volatility dies down into trading ranges. But today, I think we're just going to focus on quick profits from these sharp trends that happen when you get just a really strong move in the market. And this chart of Tesla here shows a breakout setup that I'm looking for before the market opens. I'm looking to go through and pinpoint where do I think that I've got a potential breakout of what's been going on in the pre-market that's going to be able to drive price to a profitability level. And, when you're talking about breakout trading, most breakouts fail. So bear in mind, you're not looking to fall in love with this, whether it's Tesla or anything else. You're looking for key support, key resistance, and you're looking for moves through those levels to signal that you've got a strong move either as a breakout or a breakdown. And you're always, again, going to be acutely aware of what's going on in the news and whether or not the news is going to drive those reactions. So on the right side of the chart there, you can see those are the volume by price bars that I talked about, those green volume bars there. They're those spaces between them. That doesn't mean nothing happened there. That means what happened there was less important proportionally than what's happening at those control points, at the big bars. So those bigger volume by price bars are places that we expect to see really pretty solid inflections. And then the spots that we see the gaps, the spots that we see the white space, those are places we think if price gets there again, it might have an easy time floating up through or floating down through, whatever the case may be. And when I'm setting up the morning trade in Tesla, this is also represented in my volatility band trades. That's a different animal altogether. You can watch that recording. I think it's available here. This is a little different than vol bands. This is you're establishing volatility bands based on what's happening in the pre-market. So you can see here I've got one at 453.86. Got a band drawn right there that lines up with yesterday's support and resistance. So on 11.2, you had support and resistance going into especially the closing range, and then also at about noon Eastern time. And then in the morning, we had that on November 3rd, we had that same level represent sort of a hard inflection point in the pre-market. I like to just go and band these things up. So very similar to the volatility bands that I draw at the end of the day for tomorrow's trading. In this case, I'm looking at about a 6-point range from the bottom of the pre-market up to the top of the pre-market, 453.86 up to 459.94. And this is where I'm looking for an opening range breakout or a breakdown. You've heard these strategies over the years, and if you've been following markets as long as I have, then opening range breakouts and breakdowns are not something that's a surprise to you in terms of a trading strategy. What might be surprising is a lot of people have a hard time getting them to work. And I think that it's just very important to dig into something like Tesla, take a look at how does it typically react to these breakouts? How does it react when there's a breakdown? How does it react in light of news? There was a little bit of news on Tesla. Besides Elon Musk talking about flying cars today before the market opened, there was news on Tesla in tariff world, right, in tariff land. So all of that stuff was driving price. But when the market opened, first thing we saw was this break up above that 459.94 level. And I can tell you, I did nothing with it. So I don't trade that breakout just the way that it is there, because there's so much volatility in Tesla that you can get in on a 459.95 print. Before you know it, you find yourself down at 456 and you've stopped out. And when you look at the chart again, it's trading up at 464 and you're kicking yourself because, oh, if I would have just stuck with it, I would have made money. And, I set my stops too tight and I didn't. So I like to wait for the setup to be logical, for the setup to progress a little bit. And when I see something more like this, where so the bars, as they develop over the course of the session, you can see the bar that broke up through 459.94, that one was followed by a bar that got you up through that 464.43 threshold. So we had a bar that closed above the high of that pre-market range. Then we had another bar that just consolidated and stayed up inside the top of that previous bar. So it managed to open and close in the high of the prior bar's range, and then that next bar breaks through, and as it's breaking through 464.43, we see the opportunity for a long trade, and we see a real clean place to put a stop, and that stop is not very far away on a stock like Tesla. But what we see is under that volume by price analysis out on the right axis there, well, geez, if we get down below 463.08, we got a pretty clean shot back down into 461, 460.90, and it could really sail lower. And if it gets down through the next level of volume by price, we're looking at probably a 459.94 test, and that's someplace that we don't want to be in terms of reward to risk. So we always want to make sure that we've got a good reward to risk ratio on these trades. And in terms of figuring out where's our profit objective going to be, this is where you want to go back and look at prior sessions data. You want to look at previous charts. We know that up around 470, there's going to be an area that's going to represent probably a turning point for price. We also know that if we do some fib expansions, Tesla trades very geometrically, that we can project where price is going to go as well. So 468.52, 469.77, 471.01. That 50% expansion ratio is something a lot of people follow. So 469.77 is definitely going to be something that price reacts to. 471.01, 61.8%, that's going to be a place that it's going to be sort of make or break for price. The 618 is always sort of a last stand. And 382, that's going to be the most likely place that price is going to get to. 382 is a no-brainer. As a matter of fact, we've already hit it at this point. And you can see here that when we get up into those ranges, price reacts pretty much the way that we would expect it to. So we get up and we land right on top of that 618 expansion. Yeah, it goes up another $3. It'd be great to capture all that. But I think predictive validity-wise, what you want is a strategy that you can say, I know what to expect from this stuff. I know how it typically reacts. And I'm just going to tell you, typically, a 618 expansion, you're going to be lucky you get it, and then price is going to start oscillating. It's going to start doing exactly what price did here. That's an opening trade in Tesla. That, I think, is a safe way to get myself in front of something that's got a good reward to risk ratio. I can find a setup that makes sense. The stop, as I said, the ratio on it is great. I know what the news is on the stock. I'm able to go and take a quick look before I get triggered into this thing. I can look at daily charts. I can look at weekly charts. I can look at even monthly charts. You want to have all that stuff at your fingertips. Just open some tabs on your trading software, on your charting software, and have a daily, weekly, monthly, have everything, all these different time frames there. And in a lot of cases, you also want to have, in the case of Tesla, I would use a 125 tick chart. In the case of something that moves a little bit slower than this, right? You don't want a stock that's trading 60 million shares a day. You don't want to do a 25 tick chart because it doesn't mean anything. It just flies. But a 125 tick chart starts giving you some good data resolution. And that's something that I rely on over the course of the session to put me in front of opportunities. So this is one way that I approach trading a stock like Tesla. You don't have to trade the $470 version of this. You can trade TSLL. That's 20-something dollars. Gets you in front of the same opportunities for profit. You can buy a large number of shares. So you can buy 1,000 shares of TSLL, and you have the same price reaction then that you would have on 100 shares of Tesla, because it's a 2x levered trading instrument. So there's lots of ways to skin this thing. There's a lot of ways to use these kind of strategies. You can use the leveraged version of the triple Qs. There's all sorts of things. And if you have questions about something that you're looking at, or a pair that you're looking at, and hey, what do you think of this? Just shoot me an email. Again, it's just Adrian at TradeOutLoud.com, and I will be happy to talk to you about your idea or your trading ideas. Another thing that I do with Tesla is some scalping approaches, some scalping trades. And if you guys join us in our war room, in our trading room during the day, then you know what I'm talking about. I will use a little bit different piece of software to go and figure out what's happening on a 25 tick chart and give it some meaning, something in a way that is a little bit off the beaten path. I guess for some people it's a data collection tool that's been around for over a decade, and I'll go over that in a second here, but a lot of people don't use it. I understand that's also something that's expensive, but for me, it's always worth paying a couple $100s a month for a piece of software that helps me get in front of the opportunity for profit. And if I can get in front of the opportunity for profit, then the calculus for me is pretty easy. This is going to be about taking small trades, and you're getting in and out of the market more frequently. Getting what in the case of Tesla would be a minor move. So when I show you this next piece of software and the moves that we're targeting on it, bear in mind that for a stock that's moving like $9, sometimes what we're looking to capture is 30 cents, 40 cents, and that those are the moves that you're going to be looking at on the chart. So it looks like it's making these giant outsized moves, but what you have to wrap your head around is it's really 125 tick data. It's much more micro in terms of the view that it gives you of the market than a 5-minute chart would be. So on a typical chart, I like to trade from a 5-minute chart. On these rapid execution trades, this is the piece of software that I'm looking at comes from the HFT world, and it's more of a mainstream piece of software now, but it is really still very much a high-frequency trading tool, and it gets you in front of opportunity when markets are really volatile, and you're able to find areas of support and resistance that make sense in terms of what you're trading. So let's take a look at it. This is a piece of software just called Bookmap that I think is pretty good at getting you in front of the opportunity for profit. Here we're looking at a recording of, so Bookmap is a piece of software, and we're looking at a recording of today's data. And you can see what Bookmap really does is a heat map of where institutional volume might be sitting, might be influencing the directionality of a stock. And as you watch this unfold, what it's really giving you in terms of what those round circles are is the size of the blocks that are going off of the trades that are happening in the markets. And it also shows you what's happening below the market. So right now at 19,310 shares down at 444, I know price is going to try to go there. So what we start looking for is where might there be support and resistance on this very fast-moving chart. You can also overlay 5-minute charts on top of this, but I like to keep this separate from my other trading data. And really I'm looking at, up here, this is a cluster of support and resistance that I expect to see. And if it gets up into 445 or so, I see that there's overhead volume sitting here. I see there's the potential anyways for price to make a move lower. And if it chews through this threshold level down here at 444.39, then I think most likely the market makers are going to try to get it down to pick up this this two lot down here, this 20,000 share block that's sitting below the market, because there's a lot of money to be made on those order flows over the course of the day. If you think, well, if it's a $2 broker getting paid $2 per 100, or it's really $1 per 100 nowadays, but if it gets down there, what's the big deal? Well, now imagine doing it 5 times. Imagine doing it 25 times over the course of a session. And you see there, we went up and we hit that 445 level, and we had some conviction, but it wasn't a giant order that went off there. It represents some fair overhead resistance. It reflects a point that we had absorption in terms of the trading that happened, but it might be a good place then to put on a short and look for a move from 445 down into that 443.99, 444.05, somewhere in there. It could be all the way up into 444.10 just to get in front of that order block on the way down. And now we see there's an order at 444.80 with 20,000 shares, and we can see now the sellers are coming into the market. So those are limit sell orders. You can see the market orders coming up and picking them up. But you see that up above, we still have some pretty firm support and resistance, and we see the sellers came back into the market. And here we see that price then is in fact making its way right down into that threshold level that we were expecting. So this is a type of scalping, and this is a tool for scalping. There it is. There was a market order, went down, hit that price level right on the nose, and it went off exactly the way that we would expect it to. What do you do with this data? We talk about this every day in our war room. We talk about it with the guys from the boot camp who are in there, and the folks who are just visiting to see what's going on. This is about putting ourselves in front of the opportunity for incremental profits, for additional profitability. And most of these trades, I will tell you, are over in the first couple hours of the trading day. So I like to trade the open, and then I like to come back at about 8:30 Pacific time, 11:30 Eastern time, and find some opportunities that look more like what's happening on this chart, where we see the heat map is telling us there are big blocks. The redder the level is, the more buying and selling activity we're going to expect right at one of these levels. We're going to see price get there. We're going to see the big market orders hit them. And then we start looking for things like price persistency. Are they refreshed? Do they come up again and again? And this is a nice tool to work with as long as you can keep your head wrapped around it, because decision fatigue is something that gets very, very real when you're working with this kind of fast-moving data. So this is a completely different animal than going and just boxing up the trade in the pre-market and saying, if it does this, then I will react in this way because I know what the news is and I know what everything else is that's going on. This is about figuring out in real time, where do we think price is going? Where do we think price is about to move based on the liquidity in the market, based on whether or not there's iceberg orders sitting there, based on are there stop orders sitting out in the market? Are there things in the market that are going to draw price to them? Because price is looking for liquidity. Price is looking for, believe it or not, just looking for a place to fill. Does that represent opportunity for profit? Does it represent a threat? Those are only things you can figure out if you're still sharp. So if you've already got a million things on your plate, I can tell you one of my favorite traders I had a conversation with on Friday, and he said, Adrian, I have figured out I'm good for about 3 or 4 trades. I'm always very profitable, 3 trades, 4 trades, 5 trades into the session. If I trade beyond noon Eastern time, it all starts to go downhill for me. I give it all back. That's a very real thing, and that's because of decision fatigue. That's because you're spending too much time staring at a machine, and it gets harder and harder and harder to figure out what it is that you really wanted to focus on. As this thing starts moving on, and we start drilling down on it and focusing on it more and more and more, it gets harder to figure out whether we should be long or short, let alone where we should have entries and where we should be exiting for profits and stops. So bear that in mind. Your risk management, your psychology, those are going to be some of the most important things that determine whether or not you're going to be able to be profitable. Let's talk about this a little bit. Risk management and discipline, psychological discipline, and how you can keep yourself from getting in trouble. You need to frame your opportunities for profits and your avoidance of loss in what's going on in the market. It all has to be on the market's terms. The market does not care, not for 1 second, how much you would like to make or what you're willing to lose. Those are never factors that are going to come into play. So your stops, your targets, everything has to be very, very logical. And one mistake that I've seen people make over the years just consistently is that their stop losses are based on, well, I'm not willing to risk more than $500 on this trade. And definitely a stop is there to get you out at a pain threshold. But really, if you're good at what you do, the best way to manage capital is to say, if I'm willing to lose $500 on a trade, but it looks like that trade has a $2 swing against me before I know that I'm wrong. I'm looking to make $6 on this thing, and I've got to give it at least $2 worth of wiggle room. Then the thing to do is not to go and put a stop on 500 shares of $1. What you want to do is say, I need to have a $2 stop, so I need to cut my position down to 250 shares so that the stock has enough room to move. It's got the travel range that it has is the travel range that it's going to have. And my not wanting it to go further isn't going to do me any good or do anything about its behavior. If I put the stop in place with position sizing that makes sense, it could be a $5 stop. So you could take 10 shares of something if that's what it takes to make it a logical trade, a trade that makes sense by the numbers. If you put a stop loss on a stock during unpredictable price moves, and you use appropriate position sizing to gauge your risk tolerance, to harness that risk tolerance, you're going to protect your capital and you're going to enable your success. You're going to be somebody who can become a successful trader because you're not going to take these wild swings in equity. You're always going to have control over where your positions take you. And that is just super important in terms of how emotions come into play in the market. So if you wind up, I've got a trader who he is famous now for, he will make $2,000, $3,000 right off the opening bell. And then by 10 a.m. Eastern time, he's digging out of a hole because he's not emotionally resilient. He gets very, very wrapped up in the moment. And he does things like say, well, if I go long, the market goes down. If I go short, the market goes up. So I'm just going to do the opposite. It's just this revenge trading thing, overreacts to what's going on and has a hard time sticking to his trading plan. He can do it really, really well on the open, does super well on the open. But if he starts making money, he gets greedy and decides, oh, if I'm having a good morning, if I'm having a good first 20 minutes, oh boy, the rest of this day, if I made $3,000, $5,000 early in the session, I can make 10 or 20 by the end. And by the end of the day, he's lucky if he hasn't lost that much. It's just always the case that people need to be able to put themselves in front of risk in a way that the risk is controlled. And then once you are in the market, once you're working with the market, you need to know what your emotional triggers are, and you need to be able to maintain discipline so that you are able to stick to your strategy and that you're not going and firing off random trades. You always want to make sure you know everything that you're going to do before you do it. There has to be a reason for everything that you're going to do, and you want to avoid, in any case, making decisions that are based on panic, right? If you start feeling panicked in your trading, and the best thing you can do is just close out everything. Don't reverse positions. Don't add to positions. It's going against me. I'm just I'm gonna add another 1,000 shares. I'm gonna add another 1,000 shares. Adding to losing positions just typically winds up generating bigger losing positions. And trading according to your plan is something that gives you then a very objective way that you can stay disciplined. You can be ahead of uncertainty in news-driven events, and you've got the ability to go back and evaluate everything that you did objectively and then figure out whether or not you're doing things right and where you have to make tweaks. We've got something called the Manz Trader Readiness Inventory. It's a nice test, 100 questions. You can take it for free. You get the results for free. It's not one of these, okay, now enter your credit card and we'll tell you how you did kind of a thing. I gave it to the guys at the boot camp. I will tell you, a couple of them finished it and just looked at me and said, you know what, I need a hug. It's not going to sugarcoat anything. It's not going to tell you everything's coming up roses. So go for it. It's not going to tell you there's no hope. Go find a day job. It's going to tell you how much emotional reactivity you have to the markets, how much neuroticism plays a role in how you react to the things that have gone on in the market. How impulsive are you in your trading? How good is your ability to look back and figure out what happened over the course of the trading day and objectively analyze what's been happening in your trading? Is your risk tolerance and your perception of risk suitable for what you're trying to accomplish? And how emotionally intelligent are you? How self-aware are you? And every one of these things plays a big role. I can tell you we've got lots of, let's say, very successful and very well-known traders who have taken this thing over the years. It's been validated on a lot of people. And it'll give you some insights. They're not necessarily going to be painless. They're not going to be pain-free. But it'll give you insight into what makes you tick and maybe what's going on behind the curtain when you are trading either profitably or not so profitably. If you want to take that test, it's just TraderInsight.com/MTRI. So it's the Manz Trader Readiness Inventory. It's there on the screen. Feel free to take it. If you have questions after you get your evaluation there, you can shoot me an email, Adrian@TraderInsight.com, and I will go over them with you. So finally, let's just take a quick look at evaluating trade performance and getting ourselves in front of the opportunity for continuous improvement. Successful day traders you're going to review everything regularly to track what's going on. You have to be able to learn from your mistakes, and you have to be able to adapt. So when you're staying informed on what's going on in the markets, you also need to stay informed with what your reaction is to those markets and to news events and to everything that's going on. So I think you need to have a place. I've got this thing called a Remarkable tablet where I take notes. It's like an electronic notepad, and it just lets me go through and check some boxes on a PDF that I generated and make sure that I've got everything very much going according to the way that I want to be trading. So you want to go systematically, review your trades, go through every day, go through every trade and just tick the boxes. And you want to track what's going on in terms of the monetary outcomes and also in terms of the emotional outcomes and in terms of how it affects your ability to trade going forward. So you want to see if there's patterns that you're getting yourself involved in. Are you getting in too early? Or are you getting in too late? Are you getting into the middle of a trend when you really wanted to get in on a test of support or resistance? Does getting in the middle of the trend mean that now the place that you got in is so far from the entry that you wanted that you're operating at a loss based on, if it just gets back to the entry price? Oh my gosh, now, I'm losing money and I'm only at the price that I wanted to get in at in the first place. Those are the kinds of things you can put your finger on if you take good notes and you make it a point to understand what's happening in your trading. So you got to stay, you really need to stay on top of what it is that drives your positive trade outcomes and what it is that is causing mistakes and errors. And when you have good notes and you have good insights into where you're making mistakes or what's going wrong, then that lets you develop and become a better trader. And you can adjust things and you get consistent over time. And then again, you need to, in terms of your journaling and everything else, stay on top of what's going on in the markets, what's changing, what's going on in the news cycles, and just understand that markets are a live thing. Markets are changing. We don't all stand around a ticker tape machine anymore to get our quotes. And just like that influenced the way that we traded, the move from fractions to decimalization dramatically changed the way that we trade. And the influence of algorithms, that's probably 80% of what goes on in the markets is driven by algorithms. That's definitely changed the personality of the market. This stuff evolves, and it all impacts the volatility and the opportunities that are out there. And if you just stay in front of it and make sure that you keep learning and stay updated, then you can stay prepared and just stay in front of things the way that you need to. You need to be hungry for information. You need to just want to be a student of the markets. You need to want to learn. I love teaching. Julie loves teaching. People ask us, why do you teach if you trade? And we say it all the time. Trading affords us the opportunity to teach. We enjoy teaching because when we talk to people about this stuff, we learn about it ourselves. So the more you think about the markets, the more you're going to be able to put yourself in front of the opportunity for profits. And here you can join us live as well. You can come into our trading room for a couple of weeks. No credit card for a test drive or anything like that. Just go to TraderInsight.com/trade. And you can join us every day for 2 trading weeks. See what the guys are doing, see what we're doing. We go over the trades live in the room. If you find it confusing and it's not for you, then that's okay. If you find it useful, then that's great, and you can join us regularly. Most people who are already sort of in a good place in terms of understanding how to operate in the markets, anyways, how to place orders, find all this information really useful and find the trading plans useful. And if that's the case, we'd like to work with you. And if if you're just as confused as can be after you take a look around in there, you can just let us know, and we can steer you in the direction of some resources that might make trading a little bit easier for you. Okay, so it's all about this knowledge and preparation, right? You got to understand what's going on. You have to be prepared, and you need to realize that's essential. You need to come in bright-eyed and bushy-tailed every morning and just know where you anticipate the market's going based on you're prepared for what's going to happen in the market. You need to have your strategies in place. You need to have your risk management in place. That stuff has to be solid. Paper trade it, go through it, make sure you know what you're going to do before you're going to do it. This is not about guessing. This is about being an expert at what you do. And you need to maintain that discipline and be able to adapt to what's going on in the markets and be able to just be ready for tomorrow, even if tomorrow looks completely different than what you had going on today. All right, thanks for joining me, and I will see everybody next time. If you have any questions, shoot me an email, Adrian, Adrian, @TraderInsight.com. Have a great day.